Question is, where is the money?
Welcome to Upside for the real stories behind the headlines affecting European venture. Joining today is Lomax from Outsized, Andrew from 7%, and myself, I'm Dan from SuperSeed VC. Today we're taking a look back at Q1 25. A quick look back over the last 3 months. Q1 is now over. Blimey, that went like in a breeze and a quick sharp shop. Winners, losers, ups, downs, mega rounds, and some of them minors. And then digging further into the impact of tariffs on Europe. Yes, I know we're all tariff fatigued, but we just have to. It's so bloody important. Please forgive us. Gents, what's new? Lomax, how are you? What's your week been like? What's caught your eye?
I'm great, thanks. Yep. Building out the office on the beach now, getting furniture.
Office on
getting
the beach.
Exactly.
I'll have a pina colada.
Come surfing, come for some deep work, etc. It's all actually very excited about that. Caught my eye this week, Klarna, the IPO that we've talked about that was slated for earlier this year, have pulled their IPO since our last podcast last week. I mean, not surprising really, given what's going on in markets, but it was one of the big, European-backed exit events that we thought was going to happen. I think it's probably slightly choppy, postponed indefinitely, probably slightly choppy water for Klarna now, because I actually noticed that its main peer, which is listed already, Affirm in the US, its stock is down 50% this year, so now trading at a 12 billion market cap. Klarna had been aiming for a 15 billion valuation, down from the 45 billion at which it raised money at the peak. I think buy now, pay later, which is what Klarna does, its main product, is something that actually probably might come in for a challenge with an inflationary or environment and a slowdown in the economy, right? I mean, consumer spending, be it buy now, pay later, is one of the first things that get hit. So I think Klarna may be taking a double hit in terms of the market forcing it to postpone the IPO, as well as potentially choppy headwinds on the actual commercial side. And then good news though, for Europe and for the UK is this deal that Wave, the AV AI company, automated vehicles AI company out of Cambridge, that's one of the leaders in the space and has raised 1.2 billion to date. So not many companies in Europe have raised over $1 billion. Has impressively signed a big deal with Nissan to incorporate its software in cars being released from 2027. So I think that's a really interesting big deal. And AV's, automated vehicles, obviously been through a bit of a winter the last few years, but now starting to gain a bit of momentum again. So watch this space.
It always feels like Waymo and Tesla get the kind of the AV EV credit when actually, and Tesla versus Waymo, just an example. Waymo got many more rides going than Tesla have. I think it's hundreds of thousands to zero. Anyway, Andrew, what's happening with you, my man?
I'm good, busy. Actually spent a nice day with Lomax on Tuesday. We had our quarterly strategy session for Dragon Chasers, which is the European VC LP community. So that's always exciting to plan ahead and when you're building. Other than that, back on the race circuit, all good.
Back on the race, do it. What's caught my eye this week? So I saw something quite lovely, and it's got nothing to do with startups investing, obviously Europe because it's UK, but it was Universal opening a theme park in Bedford. They're looking at a 2031 theme park opening, and I just thought was kind of cool. 28,000 jobs. The other thing that caught my eye, which I imagine caught both of your eyes as well, was this leaked memo. It was the Shopify CEO Toby Ludgar asking teams to demonstrate why AI can't perform a job before they're permitted to ask for more headcount. I think we're going to see a lot more of that.
Presumably, sorry, Dan. I mean, that is like every CEO is issuing memos like that already, right? I mean, I'm surprised it was even a story, quite frankly. But yeah.
I think it's because I think it was the leak, inverted commas. But you're bang on. I mean, this is going to be every single CEO, startup, scale up, growth company is going to be thinking, how can I tool up? And we're going to look at some of the results from the AI report later in the pod, which kind of breaks down some of the confidence or lack of confidence, the impact of AI on recruiting, on redundancies, on efficacy, on productivity. So I think we're going to dig more into that. The other thing that caught my eye was a very thoughtful AI thought experiment from the AI Futures Project. Now, they're a small research group, and they're looking at the potential future of AI. And it's a bit like an Asimov novel. And it's if you want to look it up, it's AI-2027.com, and you can have a look. It's a beautifully designed website, and they look at the next 3-4 years and the potential outcomes of AI and what China may or may not do, and what AI and super intelligence may or may not do. And it's just a very kind of smart, thoughtful, cute way of just getting all of your best and worst suggestions for how AI is going to transform the world down on paper. So have a look at that if you can. It's AI-2027.com.
It's kind of reminiscent of, I think, Max Tegmark's book. I think it's called Life with 3.0, which has a very, very similar, very similar, but a beginning that was written. That book's probably what, eight years old now, maybe 10 years old. So, had kind of massive echoes of that, although this goes into a lot more detail.
Yeah, very specific. I mean, they've obviously, I think it's 5 in the group that wrote the paper. They've obviously really kind of got everything, all of their worst fears and concerns and their excitement for the topic all down. It's highly recommend having a read. I'm going to have to ask forgiveness up front. We've got to talk about tariffs. I really want to make sure that we focus on the European angles and bring it always back to startups, investing, venture, Europe. But we can't not have a look at, I'll do a quick kind of status update, but we can't not have a look at this topic. So please forgive us. But here's a quick status update. As of the 10th of April, Trump has obviously avoided an all-out war on tariffs with a 90-day reprieve. There is a global 10%, apart from on China, which is still stuck at 125%. No Christmas presents for any American kids this year. I've written down 8 reasons, and I'd love your insight, thoughts, and kickback to this. I've written down 8 reasons why I think Trump is doing it. Many we've talked about, many are in the wider press, but maybe some other angles that are not so obvious. So 1, cheapen government debt. So lowering yields in the bond markets, which has massively backfired so far. The safe money route hasn't come to pass. Is it to weaken the dollar for international control? And if you look up Scott Bessent's vassals versus neutrals versus enemies, his green, amber, red strategy, have a look at that. It's really, really interesting how Scott Bessent, him and Lutnick are Trump's 2 right-hand men on this topic, how he's thinking about how if they weaken the dollar, they can effectively create this kind of vassal control. Is it a negotiating tactic to onshore manufacturing? Again, I can't see why Americans would want Chinese jobs, and how fast can they spin up this capacity? I think this is super problematic. Number 4, is it a bring in cash to balance the books? But then you can't have it both ways. It's either reshoring or it's, get the revenue in. It can't be both. Is it rebalancing the trade deficits, which aren't actually, when you look behind the scenes, aren't actually all that bad in reality? Is it really to fully decouple from China? Possibly. Political signaling? Probably. Bullying and control? Purist hegemony? Yeah, because that's not the greatest, smartest way to do it. But I think that's possibly just Trump all over. Some other very quick stats before I open to the floor. Even since the bounce, European and US stock markets are still down somewhere between 4 and 11%, depending on which markets you look at. What this means is that global markets have effectively been kicked back a year. Now, my personal take is that because the US now can't be trusted, I think that's the kicker here, is this trust piece. I think we'll see more of everything across Europe. And I've had a look for some kind of proxies or for some kind of insights into where the noises are. So on the people movement flow, the Aix-Marseille University in France have launched a Safe Place for Science initiative allocating 15 million euros to fund positions for American scientists. I thought that was quite an interesting play. Many investors I've spoken to this week are looking for now safer havens to balance portfolios, looking at LATAM and Europe to try and get cash out of the States and into more safe and considered markets. And then to look at yield spreads between the US Treasuries and German bonds, it's widening. China, US, and the UK are the biggest buyers of German bonds, just as US bonds tank. So I'm sure there are other proxies. Lomax, what do you reckon? What now and what next specifically for Europe?
Firstly, $15 million to fund, scientists coming to Europe is sort of seems like a very European amount of money, i.e. not a lot. I think I was reflecting on this because last week when we talked about tariffs and their implications for European startups, the conclusion, at least from my end, was like not much to see here, like head down and build. little did we know that during recording the podcast, the markets were crashing. So, there was a risk that we started to look a bit stupid off the back of that. But then, lo and behold, a week later, we've come back full circle because, with Trump delaying the tariffs and putting in this 90-day place, the markets are back up, and then now they're coming down again, potentially.
Yeah.
But I think our position on this largely stays the same. I think it's head down and build. I think when I look at what's been happening in the kind of early stage, VC founder community, I mean, firstly now, as always, every VC that I know is suddenly an expert on tariffs. We see that that happens with
Andrew
with
sent
COVID.
that beautiful meme in the week, didn't he? That shut up, darling. I've got a podcast on tariffs to record. So yeah, I'm hyper conscious that the three middle-aged white dudes sitting here talking about tariffs. Oh
we
my
are
God,
we are now.
We are the meme.
Come here. People have studied this for their for the whole of their academic career. But you can hear the best, most cutting edge insights here. I think kind of reactions amongst VCs have been anything from like kick down and build to blind panic. We've seen, you'll remember in 2008 when Sequoia put out to its founders an RIP Good Times memo. I've even seen one VC put out one of those memos, which
Really?
Clearly,
Interesting.
well, I know, which definitely seems a bit hyperbolic. I think it's heads down. Look, I'll give you an example. Yesterday I was having lunch with a founder in our portfolio in sunny Lisbon, and he's building mixed reality games. And big long-term project, like amazing founder. Talk about that another time. But one of the it's software, so no tariffs on software, right? So no kind of massive implications. But clearly there will be tariffs expected to hit X of devices, the headsets. So we during lunch we were querying what that might do to his business. We came out of lunch and suddenly realized markets were back up. Tariffs had been put on hold. So my point was we spent an hour and a half worrying about tariffs and the indirect impact on the business, when actually, these things at the macro level do not, they're so removed from what founders are doing, especially at the pre-seed and seed level. I think you need to kind of keep your head down and build for the long term. So I think the message is heads down, keep building. Let's not forget that at the moment, and probably for the future, there will be no tariffs on software. In biotech, there may be, so there may be some implications. Hardware, I think, this is an interesting one. I think if you're pre-seed and seed in hardware, you're probably working on MVPs and early customers anyway, right? So that doesn't really matter. But I think you look at Series A, Series B hardware startups in Europe, they're probably having a good old think now as to where they're going to do their manufacturing, right? And there'll be a discussion, and this is going on in some of our companies, where you'll basically be saying, well, we could do the manufacturing in Asia or in Europe, but then we'll have to hit these tariffs. Or do we move manufacturing to potentially, depending on the vertical, our biggest market, which is, say, the US, do we potentially do manufacturing there? In which case, you're probably looking at costs two to 3 to 4 times what they would be in these other geos. But of course, you then remove the tariff risk. So I think those kind of conversations will be going on in the boardrooms and between co-founders at the sort of Series A, Series B hardware startup as they move to kind of scale up in manufacturing. That's probably what happens anyway, to be honest, in my experience. You always have tariff risk if you think about supply chains, etc. So for me, head down, keep building. If I had to make one adjustment, I would tighten the belt a little bit. Think about maybe shoring up the balance sheet. If there's opportunities to take in a safe, maybe think about that. If you were planning to run into the market to make a few hires, maybe slow down a bit. I mean, that's, a lot of this choppiness can impact the fundraising markets in the private markets in VC. And so that's something to be mindful of and watch. But otherwise, I think it's just, crack down at the micro level. It's the wonderful thing about what we do. It's about, products and people and ideas, and that's it. And we don't need to be buffeted and tossed around as if we were day trading the stock market.
We were talking about the shift of LP cash from public to private markets, and there might be some interesting, apart from cash, potentially capital inflows into Europe or LATAM or other territories. I think there will be a geography play.
Well, there's that. And one thing I would say, look, to be honest, as a VC who raises money, right, from LPs, my biggest competitor in the last 2 to 3 years, quite frankly, has been NASDAQ, right? Because LPs will say to me, why the hell, they're both, it's both equity exposure,
year on year,
right?
baby. Why would I give you any money?
But in the last 3 years, it's been even more, and it's totally liquid. Whereas remember, when you invest in a VC fund, you're locked up for 10 years effectively. So I think, for me, I actually think when I go, speak to LPs now, I've almost lost one of my biggest competitors, right? Because there's still scope for alpha in the stock market, but it's very volatile. And actually, the nice thing is we aren't buffeted around by that. And if you're building for the long term, so that could be long term good, but none of this really affects short term what founders are doing in the weeds day to day in the trenches. So,
Andrew, what would you add? What would you take away? Europe startup investing, venture, ref tariffs.
I think the broad brush from Lomax is right. Head down, keep going. It's a state of flux. So it's hard to suddenly pivot and change all your plans when Trump is making changes as quickly as he is. If tariffs are going to stay, then for sure, hardware companies who are selling into the US have to think carefully about what they do. It's not as simple as just assembling your parts in the US, shipping parts in and then assembling and saying it's made in the USA. The Federal Trade Commission has pretty strict guidelines saying virtually all of your products, parts and processing must be of US origin to be labeled like made in the USA. And then I think it's the US Customs and Border Protection determines country of origin, which defines it as there must be a substantial transformation. So did the imported components undergo a meaningful manufacturing process in the US, and how did US origin parts or process contribute to the final value? How much of the value that the product delivers was created domestically? So startups that have products in market and for whom a tariff has impact on their sales potential are going to have to think very carefully about that. And to Lomax's point, that could be a significant investment in moving manufacturing or even sourcing components. So I guess to summarize, there's sort of some supply chain risk, cost of parts risk, bill of materials cost risk, which could affect end user cost.
One area that I think is interesting is biotech and pharma, and less at the startup, but certainly at the scale-up level, which is, where do you manufacture your drugs? Okay, this applies a lot to big pharma, but as I said, it applies to emerging biotech companies. And by the way, at the moment, there are no tariffs on pharmaceutical products, but if, as expected, they might come in, these are big CapEx projects and, in the tens of billions, and those could actually be, cancelled. And we've talked about, some of these projects in the past in the context of the UK. Like, these are big projects that could easily be, potentially moved to the US quite quickly. So that is one area. But I think that's a sub-theme to the broader, early stage tech startups in Europe. And it's funny, you've seen those videos this week of, Trump and Vance, working in sweatshop conditions, making socks or whatever, or, stereotypical middle Americans doing.
Oh, are these the video memes?
Yes, exactly. Of, basically,
the Chinese jobs.
Making the point that, it's not exactly these are the kind of jobs that you want done in America. But there is a serious point, which is that, and by the way, the UK and the US are on the, interesting, new news this week is that the UK and the US are on the cusp of potentially, actually agreeing a trade deal, by the way. But if you're a startup, a hardware startup, and you have a question, it's do I manufacture in the US and have a zero tariff risk potentially in my biggest market? But the cost of manufacturing could easily be 3 times what they would be in Eastern Europe or in Asia. So actually maybe commercially the answer is we'll keep building in Eastern Europe or any part of Europe,
maybe
or
take it on the
Southern
chin.
Europe. Yeah, but you can't. Yeah, it's just you can't ignore the US as such a behemoth. But yeah, of course, it depends exactly what market you're in, for sure.
I think I bet you regulations come down in Europe, across Europe in 25. I mean, we've seen a couple of softening of regulations in our industry. We saw that, I can't remember what was that FCA ruling that they're looking to clear this year. Andrew, you and I spoke about it, that 100 mil to 5 bill PE hedge regulation for investment managers. And there are other things across Europe where it feels and looks like, I think this year there's going to be a softening of any kind of cross-border or intra-EU regulation. I think I cannot
by the way,
help but think
I mean,
that's
I don't look, clearly it's part of Mario Draghi's work and, structurally making big change and reform to how Europe operates. I just am very skeptical of this, and it's
got to be the kick, Lomax. This has to be the kick in the pants. Yeah, I can't think of any other Black Swan, world change, pant kicking episode. This is it. This is it. Trump is doing his NATO defense, pullback, tariffs. This is it. This is the message. If we don't get it now, we never will.
Yeah, I know. By the time, I just think the message is so mollified and softened by the time it gets through to these people, making these laws. I often wonder whether they're incentivized by, each subclause paid by clause.
No, fair. But very quickly before I come into you, Andrew, von der Leyen, they imposed the 25%, and then as soon as Trump flipped on a dime, they withdrew. So it feels like the speed of decision making is going to catch up with the world's reality now. So I think these are good signals, right? Andrew, what do you reckon?
That's also one of the biggest impactors, the uncertainty. Markets hate uncertainty. That's likely to increase interest rates. That's not good for VC. Becomes a less and less attractive asset class as interest rates go up when you can put your money instead of a VC fund in something liquid. And it's not good for anyone. I saw a couple of potential IPOs delayed on the LSE because of the tariffs coming in. So uncertainty is the biggest problem.
Well, let's look at some of the reports. So there are two reports that I want to dig into. One is the state of venture and one is the state of AI in the UK from Tech Nation. So starting with the state of venture, this is just a Q1 2025 report. It's from CB Insights. It's a global report, but there are some European angles. And obviously the figures are very much skewed by these AI mega rounds, such as OpenAI's 40 billion last month. Global venture funding hit 121 billion in Q1 25. That's the highest quarterly total since the crazy Q2 22. AI companies accounted for 20%, depending on how you define an AI company. But again, that's a conversation for another time. That was a new high. 8 early stage AI companies secured mega rounds of $100 million or more. Early stage deal size rose to 2.7 million. Now, this is a global aggregation, so take it with a slight pinch of salt. But this is up from the 2 million in 2024, about a 35% increase. Record-breaking M&A in Q1, 12 VC-backed deals exceeding 1 billion in value, set a new quarterly record. On the not-so-positive side, deal counts continue to decline for the fourth consecutive quarter, a 28% drop year over year. So there is a capital concentration, which we've seen before. Here's something I found quite interesting. A lot of CVC activity has fallen off a cliff. So Asia CVC is down 34% year over year to 7 billion. That's mainly China. I guess no great surprise with their economic challenges. And the UK saw its lowest share of regional VC funding in over 5 years. France, Germany, and the Nordics are now gaining ground. And on the CVC front, European CVC is down 40% year on year. As far as I can see, only 2 European unicorns minted in Q1 2025. So Andrew, anything else caught your eye in the CB Insights State of Venture 2025 report?
There's a lot of dry capital still out there. And at some point that has to be spent. So we can only stay in this sort of, I think we'll only see this
deployed, not spent.
Retreat.
You got to be careful. Deployed, not spent.
Given away. There we go. This. Charity, philanthropy.
We'll only see this carry on for a certain period of time, and eventually the cycle will turn. I think the bigger macro change in the cycle is a focus back on reality from sort of momentum bubble investing. It highlights in the report a focus on profitability over growth and capital efficiency and more disciplined rounds, both on terms but also on the government side. I think that correction was long overdue. But things are still frothy in certain sectors. The generative AI sector is still incredibly frothy. I still feel that's going to be a bloodbath in the next 2 to 3 years. Defense is still up across the board. I think it's looking at, was it 8 billion? They're looking at being spent globally on investment in defense, which is double from the last year and more than a number of previous years put together. So it's a bit of a mixed bag.
I think climate was up as well. Lomax, what else caught your eye?
This is a cracking report, by the way. I think it's fascinating. What caught my eye? I mean, clearly, of the 120 billion, OpenAI was 40 billion. 40 billion, so 1/3 of the total amount spent, deployed in Q1. And by the way, just for context, right? In Europe, in 2024, the amount of money invested in the whole of the European venture market was 45 billion. So one round in Q1, by OpenAI is basically the same as the whole of the European market. It's phenomenal what's going on out there right now. I think Andrew's totally right. Where you see VCs and VC capital flock towards and coalesce around something in an aggressive fashion as you're seeing now, there's going to be a bloodbath. In a way, that's like, I think the people who are doing those deals know there's going to be a bloodbath, but they're so paranoid of missing out on the kind of one or two generational companies that comes out of all of this, that, they're going to keep doing it, right? They're going to be term sheet. I've this week chatting to a, AI focused fund in Europe, about some of our, US colleagues with much bigger funds throwing term sheets down in the double-digit millions with literally no DD. That's the kind of stuff that's happening because, in a way, the fear of missing out on another Google is bigger than the fear of losing.
This is back into Zerpy bubble territory. I've got one quick thing for you on the amount of money raised specifically by OpenAI. I'm seeing more and more businesses that look at the efficiency of models and looking at compressing models. It feels quite an interesting play to see all this money thrown at infra, data, all of the AI, whether it's inference or training or whatever it is. And I'm wondering how much of that's going to be required as these models and these technologies become more and more efficient. So do you
pretty
think
niche to me?
Is
That a really
compression
venture scale business that just optimizes one factor of the current technology?
I don't know enough about the specific businesses doing that function, but it feels like, and DeepSeek was obviously a massive chunk out of this story as well. It just feels like there will be more efficient ways to get the same kinds of results that OpenAI and Anthropic and whomever are producing at the foundationals level. And I'm wondering how much of that 40 billion raised by, and I know it's a numbers game and they've got to go for it and they've got to go nuts, but I'm wondering how much weight that's going to give them as things effectively become more efficient. I don't know if either of you got any thoughts on that.
Well, I think they'll be using that money to make themselves more efficient. I mean, that's how they're incentivized to operate, right? I mean, as there will clearly be third-party companies offering, service or software or hardware solutions to make AI more efficient for sure.
I guess they can buy the world anyway, right? They'll be disappeared pretty bloody quickly.
Would you rather have your money in one of these, one of the model companies that develops the model, or one of these tooling companies? I don't know, probably in the former rather than the latter, quite frankly.
Yep.
But that is a whole thing in itself. I mean, we talked about, in the context of Europe, for example, energy prices that, more or less give or take double what they are in the US. Like, this is a big constraint. So anything you can do, I think we mentioned the other day that I think it's in Ireland that, in I think 2026, 2027, data centers will use a third of the electricity, generated in the whole country, right? And that's the same in, many other European countries, right? Actually just chatted to someone the other day running a data center. They trying to get the biggest barrier to data centers, for example, in Europe, is not like in the UK, at least, it's not necessarily planning permission, the things that we often complain about. It's access to power. They can't get the power they need for their data center until 2035. That's 2035, right? So the point is that actually anything that can be done to make all of this more efficient and get, better ROI on the capital that's invested in OI, for sure. I'm sure there's plenty of opportunities there. But just stepping back to this report, I think the M&A piece is interesting. I mean, I think there's,
Yes.
I think one of the biggest kind of things that isn't spoken about enough in venture is the huge liquidity crunch that we have in our industry. Actually, there's just a complete dearth of exits and liquidity flowing back to LPs, which is absolutely crucial because that money gets recycled back in. And clearly in Q1, the numbers have again been skewed in the positive favor by the Wiz acquisition, the 33 billion acquisition by Google. So I think it sort of shows, it's funny, both the M&A number is moved immensely by Wiz, as is the investment number is moved immense. It shows the kind of power law nature of just venture. Everything in venture, every statistic generally in venture is driven by power law, right? But I think actually, if you look at the M&A, the numbers, it's actually a little bit. You dig into the detail, it's a bit lukewarm. There were 2,000 M&A events in Q1. Well, actually, last year there was an average of 2,100, 2,200 per quarter. So Actually, our M&A is still a bit soft. You know, you can, if you strip out the Wiz deal, it's something, I think that's a major issue in our industry, and will be
but that's like stripping the Mag 7 out the Nasdaq, right? It's the same.
Of course, and it's like me showing my portfolio to an LP, and they strip out the one outlier and say, well, actually, this isn't any good. And I was like, that's the whole point of my portfolio construction. But I think that is interesting to watch. I mean, look, as I said to you earlier, Dan, and I don't want to get too depressive here, and you know, it's like my biggest takeaway from this report is like, where is Europe? Like, you know, top 10 deals, 2 are in Europe. Yeah, Isomorphic Labs, which was around 600 million round that took place 10 days ago, which is the sort of commercial arm of DeepMind's, which is sort of quasi an Alphabet subsidiary. But, you know, it's a UK, you know, origin company. And all the money that's gone into that is US. But, you know, I think that one of the biggest things my takeaway from this report is that Europe kind of doesn't feature that much in any of these kind of big numbers, you know, in any of the top 10s of the top 10 Series A's, the Series B's, the Series C's. And that does give cause for concern, but, you know, on the positive side, it's a low base and things can only get better.
Well, going back to the type of investments that are interesting, we steer clear of this recent batch of generative AI. I think it's really hard to predict where the big behemoths in the market, where their customer feature set will end and begin. So unless you're doing something very specialist where you know that OpenAI or an XAI isn't going to provide functionality out of the box in the near future, because it's a large niche vertical, or large vertical you're going after with a niche solution. But for a lot of people, I think that stuff's good. But we focus really on the foundational stuff, and that can be new chips, but it could also be infrastructure or cybersecurity, areas where we know that regardless of the pace of change of AI, there is going to be demand. I mean, data centers alone, you mentioned those, Lomax. I think between 120 and 130 hyperscale data centers per year are due to come on over the next 5 to 10 years. It's a huge amount of capacity. So looking to double the amount of capacity totally available. These are buildings with thousands of servers in them, hundreds of thousands of square feet. And yet today they require inordinate amounts of power. We just know that that's inevitable. It's inevitable. In fact, those numbers may even be an underestimate. So as a VC, I like to look at stuff which is predictable and we have certainty of the direction of travel. And then it's a question of, is the technology step change enough, knowing that there will be this demand? And I think with the generative AI stuff, which is still very bubbly today, you're down in the weeds on sort of trying to pick a winner. It's like B2B SaaS, right? Yet another B2B SaaS tool. The best investors these days in those areas are ones that know an area exceptionally well and can judge that either the team or the specific product design and feature set is going to win or build out and be big in a market. And because we're generalists when it comes to deep tech, we look for more foundational solutions, which we know will be needed and be hugely valuable.
Well, let's slide into the UK, because Tech Nation have launched their UK AI sector report. I think it was yesterday. It's Thursday the 10th today as a date of recording. So I think it was yesterday they launched this report. And again, this looks at Q1 2025, but specifically in the UK. So CB Insights is the global report. This Tech Nation report is looking at AI in the UK. Just for some context, some highlights of the report. UK has 2,300 VC-backed AI companies with a combined market valuation of $230 billion. UK AI startups raised just over 1 billion in Q1. 76% of UK CEOs say that AI is having a positive impact on growth. I'm not quite sure what that means or how you unpack that, but that's still, it's good that they're feeling positive, I guess. Only 6% saying that AI is affecting redundancies. I don't think that is going to stay that low for very long. The UK AI policy in the doc omits any meaningful focus on growth from my opinion as I was reading it. So they've got a timeline in this report of all the UK's AI policy aspects, and it just reads like a fearful grandmother worrying about their grandson or granddaughter going out for a night in Croydon on a Friday. So it just feels like, come on, boys and girls, we need to focus more on growth. And no great surprises, growth capital and talent were both listed as the biggest blockers. Now, I think they're both relatively easy to fix, but you know, we're still floundering and pondering. Lomax, we've talked a bit about this report. It feels a bit kind of lackluster-esque, but what what were your key takeaways?
Yeah, I mean, first of all, I think I had to take a bit of a cold shower after reading the CB Insights report. It just like sheer lack of, presence of Europe was slightly depressing. This report, I don't want to be a dick about it, but I sort of slightly think it doesn't really tell you much. It's a bit meh. It's just how I would describe it. Like, it's sort of bless these guys for pulling it together. But what were the kind of? I'm just trying to think what my takeaways from it were. So,
but
okay,
maybe they're the
side,
takeaways, Lomax. Maybe the takeaways are that there's just not enough to get your teeth into. Is that?
No. Okay. Well, what I will say. Okay. So, good, on the good side, let's try and be positive for once. Is
upside, baby, upside.
There are some great AI. It reminds you that there are some great AI companies in Europe. In the UK, right, and that have raised money this quarter. Synthesia, Latent Labs, 11 Labs, Luminance, on both vertical specific AI companies and more kind of horizontal AI companies. So I think that is a refreshing thing, and those companies could become very, very big companies, right? And actually go on to raise the big mega rounds that we've seen more in the US. I mean, I don't find these reports that helpful. Like, they call it an AI report, but they kind of then, I sometimes wonder whether they're shoehorning the conflation between software. What was just a normal software company and what is now an AI company is conflated. So, for example,
they never ever clearly define what an AI company is. And I understand
which means
it's hard.
Yeah, it's absolutely. But then it means that I sort of feel like they're using the, cherry picking data to kind of portray the sort of picture that they want, which is like a slight movement up and to the right, etc. But, nothing game changing. And yes, we're doing better
but that's
than Germany and
that's not a UK
France.
thing. No, that's not a UK or a European challenge. What is an AI company, I think, is a global report challenge.
I agree. I'm just talking about the utility of this report, which is what you asked me about. I would say, okay, so, for example, they have Flow Health, the successful women's health company, and Lindus Health, which is a great company, by the way, which is working in clinical sort of modern data-centric, tech-first clinical research organization working in clinical trials and biotech. Like, these companies both predate the kind of recent AI boom, and we're basically software companies that now, I guess, are AI-enabled software companies, but they're not like core AI companies like Synthesia, Latent Labs, 11 Labs, etc. So I feel like there's a conflation which makes the whole thing a little bit confusing. The founder of Clio, Barney Huss-CEO, there's a long quote from him in this report, which maybe you've seen before on LinkedIn, but I think it delivers. It's quite a damning insight into what where the UK is and what we need to do. I think either I can read out the quote now, or you can go away and read it in your own time. But I'll do it, and we can have a 20. This is the founder of Clio, right? A UK fintech AI company. So, who moved to the US to build his business. So 20,000 users in 24 hours. That's what happened when we launched Clio in the US. Not because we had some revolutionary new technology, but because we offered something desperately needed in a market ready to embrace conversational AI for finance. This isn't just about America's bigger market or the UK's regulatory caution. It's about a fundamental difference in how these ecosystems approach the future. The UK produces world-class talent and attracts serious investment. What it lacks is the infrastructure and mindset that lets companies dream at scale. British founders aren't told think bigger, they're told grow cautiously. It's a subtle distinction that makes all the difference. Britain's moment to become a global AI powerhouse won't wait forever. We need regulators who see growth as part of their mandate. We need to unlock investment from pension funds into venture capital. And we need to make Britain the obvious choice for AI talent, not just a worthy alternative. So, amen to that. In terms of a wake-up call,
I'm going to give him the slow clap in the high school gym. I think that.
What's he pointing to? And actually, interesting. Are you checking out the latest? Plugging other podcasts here, but not the Harry Needs It with 20VC when he was interviewing Stan Boland, former CEO of 5AI, sort of bit of a kind of European deep tech operator, OG. Basically saying, I'm fed up with everyone complaining about the UK, but he's basically saying, what do we need? More money and better talent, or better migration policies, immigration policies, and better, that's it. I think talent and money. I mean, it's very easy for us just to sit here and say we all need more money, but I really, really do think, and here are two very, smart operators calling for that. So I think that's one of the takeaways from the report.
I totally agree. I think they're relatively easy problems to solve. whether we'll get there or not, a debate for another time. Andrew, what did you think?
Bit of a mixed bag, isn't it? I mean, it's great to see these big numbers, 2,500 AI companies, but what is an AI company? It reminds me very much of the mid 2000s as mobile collided with the internet. And for a period there, everybody was a mobile company as if it was some sort of defining factor about the business, which would mean they win when they wouldn't otherwise. Every deck I get through has AI in it somewhere. So to your point about are these really 2,500 AI companies? I suspect up to half of them aren't, possibly even more. At least we have a lot of companies and startups. At least money is going in. But the biggest challenge I had with the report overall was some of the contradictions. The report recommends on the first page that actually what we need is more R&D tax credits. Yet that's the reason AI leaders later on say is the least important reason for staying in the UK. Worryingly, the reasons to stay in the UK are not what you would want. The top three reasons are family ties, cost of relocating elsewhere, and access to UK customer base. The ones you would want to be the reasons to stay in the UK, talent pool and access to the UK financial centre, listed last. And conversely, the reasons to relocate out of the UK, number one is better funding elsewhere. And then on the next graph, number one thing that we need to change is more growth funding. And this isn't just a case of everybody saying, oh, we need more money, we need more money. This is remains an existential threat to the ability of the UK to produce global winners. And we see it in our portfolio. I said it before, I think 50% of our active portfolio is subcode or top code in the US, primarily because of funding. You know, you can get access to a market in the US by opening a sales office. That's no problem. But these companies are having to go there for the money. And we need much more radical solutions. And that is not government funds run by the government, but it is unwinding some of the government policies that are making the UK less and less attractive, both for VC to live, for funds to be started, and for entrepreneurs to exit. You know, until that ideology changes, that, you know, tax the rich, tax entrepreneurs, tax these people who might make, you know, millions after spending 15 years, you know, doing nothing but building their companies, not seeing their kids at weekends. Until we get out of that mindset, we're not going to see the growth we want. So there's lots of good indicators. I think we're still sort of keeping up with the Joneses and with France, but for how long? For France particularly, if Europe does get its act together with EU Inc. and it becomes more of a single market, that's a big if, by the way, then the UK really is going to lose its crown. But for today, it's still there. Today, we still have tons of talent. I'm just so frustrated that some really simple government changes in policy around like visas and immigration for high
and
tech
pension reform.
People. Yeah, well, sure, and pension reform, but then just unwind the entrepreneurs relief that you've just killed from 10 million down to 1 million, which they'll probably wipe out completely. I just, I'm back to being gaslit again by government policy, basically.
Oh, I can feel the fists about to be waved. I want to end on an upside. I want to end on a positive, because Lomax, you've got an interesting deal of the week. Tell us more about that.
No, I think in the context of deal of the week, I mean, I think a company called Polar Mist. So this is a seed deal, so it's not a big, you know, multi-million deal. Company that's come out of stealth, a defense company, working on ensuring European maritime supremacy and sovereignty. So they initially are building out a optical GPS-free navigation, so an unjammable communication system and mapping system, and then they want to move to work onto full autonomy, both software and hardware, effectively arguing that the ocean, the sea, is absolutely important for military supremacy, which I don't, you know, goes back hundreds of years to he or she who has control of the seas is the one in control. So I think very interesting. Follows, you know, the US playbook, following in the footsteps of a company called Saronic, which we talked about on this pod before, that has raised $845 million based in Texas, that is effectively the maritime Anduril. We again talked about Anduril, which is the new, you know, wannabe defense prime in the US. So I think this is interesting, backed by Nathan at Air Street and Eric at 201 Ventures, a new defense fund. So really cool to see the deal. I think it was, as always with Nathan, the kind of marketing and positioning was really, really well done coming out of stealth. And I think this is great to see this kind of thing. So that deal caught my eye. And on the fundraising side, our friend Lauren at Revent has just raised 100 million euros for her second
they
fund.
closed today, didn't they? Loving it.
I think that's great. Focusing on climate, based in Berlin, and flying in the face of what's going on in the White House. Amazing to see that
Good for her.
that underway. So exciting to see these things. We touched on Isomorphic earlier on in the pod, which was a round that closed last week, but that was a 600 million raise, right? And I know it's a bit of a funny one because it's effectively a sort of quasi subsidiary of Alphabet, but that's a UK company that's the commercial arm effectively of DeepMind and the science that's been pioneered there. Most of the money came from the US. It was led by Thrive Capital, who's been putting a lot of the money into the OpenAI rounds. But actually, I didn't even see a European investor in that round. But good to see, at least there's another kind of big deal that got done in the last couple of weeks. So interesting things are happening on the ground for sure.
We've had some great news. There's too much to cover here, but I'll pick two things out that I was particularly excited about. Jensen AI, London-based distributed AI company, launched 4 core open source releases, which is central to their vision for a networked approach to machine learning. So this is where the compute is spread across hundreds, thousands, tens of thousands of machines. So that's extremely exciting to see that go into the wild. And then back on defense, Green Jets, which we were first ticket into about 2 years ago now, completed a $7 million seed.
Nice.
Actually led by Tangling Ventures, an Indian fund, because they'll spin up a manufacturing facility in India, but also
have they thought about the tariffs?
In a change, well, exactly, but in a change,
we'll have to do a pod on that.
In a change to some of the sort of strategic priorities, with all the geopolitical upheaval, they've got a couple of contracts that are requiring them to build exclusively in the UK to guarantee supply chain, etc. So they'll actually have multiple places where they build. So it's interesting to see how you see this stuff on the news, the Ukraine and the pullback in the US from Europe, and it does have an impact on policy and does have an impact on these startups on the ground.
Pretty bloody direct. Awesome. Thank you, gents. Let's catch up next week. In the meantime, have lovely weeks.
Bye.
Thanks, Sam.
The biggest unanswered question is, where is the money?